After a short squeeze, when shorts have been either forced or because they're panicked a little bit to come out of their shorts because they fear that exposure. Now, what that does in effect is it reduces the borrower demand.
You're listening to Traders Insight Radio by Interactive Brokers. Find more podcasts and daily market commentary at tradersinsight.news. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show. Let's get started.
Hi, everybody, and welcome to Interactive Brokers Traders Insight Radio. This is Steve Sosnick, Chief Strategist at Interactive Brokers. I have with me today a colleague who I've worked with for over 20 years now. He and I talk frequently. We've done so for decades, literally. It's my colleague, Bill Pepe, who manages our stock loan department, and we hope to demystify the topics of stock lending and short selling because these are continually of interest to our readers at tradersinsight.news. And let's get going. Bill, why don't you start by just giving a quick background? I think I've given the basics, but if you could just flesh it out a little bit so the listeners know who you are.
Sure. First of all, I thank you for the opportunity to speak to you and our audience. I think it's probably best if we do a little stock loan 101 so we can get the basics down, and then we can delve into other things. So first of all, as you said, I manage the stock loan desk in the U.S. and in Canada for Interactive Brokers, and have done so for quite some time, as you alluded to. In terms of stock loan 101, in terms of terminology, I think one of the things that mystifies folks is it often is stated under different names. So stock loan, stock lending, securities finance, it all sort of falls under the same umbrella. So let's talk a little bit about the key purposes of stock loan. Again, I just want to pin down the basics so we can dive into some other things. You have several components of a stock loan deal. For starters, none of it would happen if there wasn't borrow demand. So the stock borrower is a firm that typically has a short sale obligation. That is the primary driver of borrowing stock, although it's not the only driver of borrowing stock.
Let me just interrupt for
Sure,
1 second,
sure.
just so we get really the basics. If you sell a stock short, somebody is expecting that stock on the other end of the transaction. Therefore, since you're selling what you don't have, your broker, the clearing firm behind your broker, is required to borrow those shares to make delivery to whomever bought the stock from you. They're expecting stock. They don't care that you're a short seller. The process of facilitating that delivery is what we're discussing now. And by the way, let me state for the record, this is a legal activity. This is something that is routinely done in the markets. I'm going to say this is a lubricant to some extent, like some of the motor oil that goes on behind the scenes in the marketplace to facilitate transactions.
Come settlement date, which is typically 2 days after the trade date, that short seller has an obligation to deliver shares to the buyer. And that short seller has a couple of possible sources to satisfy that short sale obligation. They may have shares internally, in other words, from another long customer, or perhaps a proprietary trading bucket that they may use. If that's not the case, they may look to borrow externally to satisfy the borrow obligation. And that's where the lender comes in. So what's the lender's primary motivation to engage in a stock loan deal? Well, the number one reason is to generate revenue. You have long stock, and I don't want to say it's collecting dust because there are many uses for a long stock, but you can use it to lend it to a borrower and charge a particular rate in order to generate revenue. There are secondary reasons for both borrow demand and loan and lending supply, or the inclination to borrow or lend. And we can touch upon those in a bit, but let's focus on this primary circumstance, if you will. So the components of a stock loan deal are the quantity, that which the stock borrower wants to borrow, the value, which is, generally speaking, the market value of the quantity times the market price, the duration, which far more often than not is overnight. In other words, the stock borrower has the right on any given day to return the shares. The stock lender has the right on any given day to recall the shares, ask for them back. But let's talk about the rate a little bit, since that's what steers the revenue or the cost associated with the deal. So generally speaking, the greater the borrow demand of a given stock relative to float, or more accurately, the lendable supply, the greater the cost to borrow.
Let me just interject here that float is what you can look up. You can find that number relatively easily. It's public. It's the shares outstanding less those shares held by the company itself or insiders. The lendable amount is not a number that's known to people because not everyone either chooses to or is obligated to lend their shares. And so the availability of a borrow, that lendable amount, can be a bit opaque.
No, you're right on the money. And it can also be said that the short interest is also opaque. Yes, it's reported twice a month, but it's not reported on a daily basis. So not everybody knows what the collective demand is to borrow stock. And so generally speaking, those are the supply and demand factors that weigh into the cost to borrow.
Let's go into that cost of borrow because in a basic sense, there's the concept of general collateral. And general collateral are shares that there's no reason not to be able to borrow or lend them. They're plentiful around the street. They're not in particularly high demand for short selling. And effectively what goes on in stock loan is it's a secured loan. So there's not really a ton of contraparty risk in here. The shares are held in the depository. The counterparties are usually members of the clearinghouse. And in the vast majority of cases where it is general collateral, think IBM. There's nothing particularly special about borrowing or lending that stock. That's going to take place around Fed funds rates, correct?
Indeed.
And so that rate should have gone up a little bit, which does increase some of the revenue to the lending firms, just because we're after the most recent Fed rate hike, there's 25 basis points to it, whereas before the transactions were more or less happening around zero. Is that correct?
That's right on the money. Yes.
Yeah. So this is just the economics of it, and the basic economics. The fun really comes in when we're talking about things that are not general collateral. And I'll let you lead into that when you feel it's appropriate.
And so the fun, as you say, is especially felt on the loan side, of course, because you have the opportunity to charge a market rate, but a rate that is a greater offset, if you will. I use the word offset to describe the difference between the benchmark, which is Fed funds, as you noted, and whatever the rate may be. So let's say we were charging negative 1%, and the prevailing benchmark rate was spot 2.5 after the rate change hike last week. That offset would be 125 basis points that we would charge on the transaction.
Spot 2.5, that's just a fancy way of saying 0.25, 0.25, which is the prevailing rate of interest. There's something that's very specific to stock lending that doesn't occur in the real world all that often. The numbers are quoted in negatives, and it's important to understand why there's a negative. But why don't you explain it? Because effectively, when you borrow shares, you're lending money and vice versa. Why don't you explain a little bit why stock lending tends to be expressed in negative numbers?
Sure, and I think it's fair to start off with your example of IBM or any other highly liquid GC with general collateral stock. So let's imagine
yes.
That Steve and I are stock loan counterparts working at different firms, and I'm going to lend GC, IBM, or Microsoft or what have you to him. So I'm going to lend, let's say, $1 million worth of IBM to him. He's going to give me $1 million simultaneously. It's one transaction that occurs versus payment. So the $1 million comes to me, and that is Steve effectively investing his money since this is totally available to borrow. There's again no reason why there would be a shortage of supply. He's effectively investing his money at the opportunity for which any broker dealer would have to invest that money, which is somewhere around Fed funds, let's say. Okay. I think it's a reasonable expectation. Okay. Now, let's say that he is borrowing, excuse me, let's say he has shorted
Fed
and therefore
funds.
borrowing a stock that is highly in demand relative to supply. And he needs to make good on his delivery obligation associated with a short sale. And it's not readily available. He can't call up any number of however many firms are on his roster of counterparts to borrow the stock. He's going to have to work hard to borrow the stock. And as luck would have it, I do have it in-house as lendable supply. I am going to be able to charge, as you would with anything that is scarce in supply, I'm going to be able to charge more for that stock loan. And the way we process his payable or my receivable is in the form of a rate. And that rate would be the sign convention would be negative on the deal in order for the stock loan post-trade processing to handle that billing appropriately. Does that?
Well, let me just clarify. In exchange for lending the shares, you get to borrow money, but you get to borrow that money at a negative rate. So effectively, for that $1 million that we contract to, when we unwind the transaction, I give back the shares and I get back $990,000 or something to that effect. So effectively, you're borrowing the money. You're lending the shares and getting the opportunity to borrow money at a negative rate, paying me back less than I would have received in a normal case. In the example you gave, 1.25% less or whatever. But that's why it's negative, because
that's a fair. I probably wouldn't have otherwise stated it that way, but that's a fair representation of.
Please tell me how you would state it, because you've got
No,
much more experience with this.
I think that sort of captures it. I would say that the borrower is willing to forego. I mean, it's all baked in, right? But he's willing to forego the opportunity to earn a rate as if he were borrowing IBM to be able to borrow something that's highly in demand, and therefore willing to pay up for it. But the steps that you just described that actually captures it to the layman a little bit better.
Thank you. The logic here would be, why would you ever do something that has a negative rate? Well, you're doing this, you're speculating. And again, this is legitimate. This is legal because these shares are all borrowed and subject to FINRA and SEC regulation, done legally and appropriately. You think the shares are going to go down by more than the amount that it's going to cost you in terms of your stock loan. That's the rationale for it. There's a reason why people do it. Sometimes there's an arbitrage. Sometimes it's outright speculation. We'll get into some of that as we go on. But I wanted to get through the mechanics, because once we start talking in negative rates, that tends to baffle sometimes, and for good reason.
Indeed. And I would like to add one other thing on the topic in terms of a firm's inclination to borrow in negative territory. You and I can both recall a time where firms would not at all be inclined to borrow in negative territory. In other words, be inclined to pay up to borrow. And that was a time when there was no legal ramification for failing to deliver. And this was prior to 2008, if memory serves. And it's at that time where the rule came to be that you had to close out a short position if you failed.
Reg show is the term you hear all the time. Regulation, SHO being short sale. Reg show is a common term. Sorry, didn't Just wanted to throw that out there.
Yeah, no, you're right on the money, and I'm glad you mentioned it by name. But prior to this rule, firms would willingly fail, and it was a streetwide thing to which the regulators and I'm glad they did said, whoa, 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 what's going on here? Let's prevent this activity. And they instituted several rules, and one of them was, you fail, you have to close out that short obligation.
I will say that a lot of the bad name that short selling got was from what I would call the bad old days. You've heard about naked shorts, and that's what Bill's referring to is when you shorted a stock without the ability to borrow. That creates failed transactions. The street used to sort of brush them under the rug. Okay, no, and people would yell about it, sometimes fairly, sometimes not. I think a lot of the worst of it got overblown, but there were some fairly nefarious situations, and I think the SEC did us all a favor by codifying what is required and what is not. And this was a case, and I hope you agree, of sound regulation rather than regulation for the sake of
I do agree
sake of
100%.
regulation. Let me also explain something else that I think mystifies people in some regard. Well, I'll let you explain, I should say. Stock loan is one of the few remaining opaque areas of the financial markets. It's really not visible to many people. The transactions still tend to be broker to broker rather than exchange driven. Can you explain a bit more about to what extent it's still kind of behind the scenes over the counter market? How much transparency has come into the business since you've been a part of it? That sort of thing.
So I'm glad you brought that up. So it's gotten better. It's not completely transparent to the public, but it has gotten better in a number of ways. Automation being one of them. There is better data, at least to insiders, at least to stock loan personnel, and to a large extent to institutional traders. There are a number of vendors that collect and distribute stock loan data. You know, does the average retail trader, the mom and pop of the world, have access to this information? And should they? No, they don't, and they probably should. And in fact, Interactive Brokers does a very good job on its trader workstation of providing a lot of this information, such that its customers have visibility to it. There is a proposed rule that is being discussed that is going to add some transparency to the general public. As you suggested, was insufficient, for lack of a better word. That is being discussed at a high level, and it's probably going to be something that comes to fruition in the next year.
It does. Can you go into some of the rules? Because one of the things that I think caught a lot of people by surprise is that stock loan, the basic amount of stock loan data is reported by the exchanges every 2 weeks, and even then on a lag. And I think that came to play early last year, and we'll get into a lot of those mechanics. Is there some talk about requiring the dissemination of short sale data on a shorter time frame? Or
I wish that were the case. I haven't heard about any regulation that is going to disseminate short sale data more than the twice a month, and as you said, on a delay. There are some stock loan specific, and it's important to distinguish the difference. To use stock loan data as a proxy for what the short interest is out there is a misleading thing. What it misses is the component of internalization. And I just want to kind of revert back to what I said at the beginning of the call, which is when you are a short seller, when a clearing firm has a short sale obligation, generally the first thing that they do is they look to tap into what shares they have on hand to satisfy that obligation. And it's only after that they absorb that sourcing, if you will, before they go out and they borrow the shares externally. So the first piece of that is not and will not be contained in this Exchange Act that is being proposed. So there's a significant portion of the short sale quantity that is not captured in this stock loan data that they're going to require to be reported. And so I fear that it'll be misleading in a sense.
That's important, because I think that is lost, and I think that actually plays into the fact that depending on which brokerage firm you're dealing with, you can get vastly different answers as to what is shortable or what a rate is at any given time. Your broker has what they call a big box in that security, which is the amount of lendable shares. It's relatively easy can be relatively easier for them to fulfill a short sale obligation, either the fact that they can versus can't, or the price to you may be better. I would say, without being overly promotional, that there are certain brokerage firms I could think of that you and I work for that tend to have a large box of available shares and tend to be fairly transparent with the rates. But I think, at firms that don't have that, you can get into some nasty surprises, because they are more likely to need to go out to the street to fulfill their customers' short sale obligations than one that can do so in-house. Is that a fair approximation?
Yeah, that is 100% accurate. And what I like about Interactive Brokers platform is not only do you get a good indication of the shares available that you may short, which by the way are decremented per short sale. So it's not like IB shows X amount and then short sales occur and they're not reduced. They're reduced to the degree that there are short selling going on, but also the indication of the rate for as much as we can possibly know now. We can't predict the future, but it's a real time rate based on what we know now.
Those rates can be very fluid. If you have,
it certainly can be fluid, and I don't deny that. But we're not in the crystal ball business, and so we can only present what we know at this moment. The other things that I kind of like, and I'll take my promotional hat off in a moment, but there are other statistics presented, such as utilization, and utilization can be a very good indicator of an expected rate, not only to pay on a short, but if you were involved in the stock yield enhancement program, which is a revenue sharing program, where IB would have a documented relationship with a customer to allow IB to lend those shares, and then the revenue is shared per those loans. So again, the ability to see, all right, well, what's the expected utilization here? Is it 90%? Is it 2%? And what's the expected rate? I think that's kind of the kind of transparency that you alluded to when we started to veer towards this topic.
It's important also to remember the distinction between margin accounts and cash accounts. If you have a margin account, which the vast majority of customers at Interactive Brokers do, those shares are pretty much free to lend. Not free to lend. That's the wrong term. Available to lend because they're held in street name as opposed to your own name. Whereas in a cash account, though you can opt out of letting your broker lend the shares. Where I don't think that's available in a margin account. Is that correct?
Yeah, a margin account, the broker dealer, any broker dealer, has the opportunity, the right and the opportunity to hypothecate 140% of the debit balance. And so, perhaps that means pledging, or more likely it means the opportunity to lend stock that are in the accounts associated with debit balances.
Yeah. So that's, so sometimes you hear, oh, I don't want, there was a whole bunch of misinformation out there. I don't want to lend my shares, or, if I use a market order, your shares won't get lent, or if you use a limit order, first of all, let me state for the record that Stock Loan has no idea whether you placed a market order, a limit order, a good till canceled order, a day order. That's all irrelevant because they don't see the transaction until it's in the settlement process, not during the trading process. So let me just clarify that misinformation that got out there, sometime in 2021. There were all kinds of crazy theories. That's not one of them. But also what it means is there are situations where people want to squeeze the shorts by not lending their shares. But if you hold those shorts, if you're the person who doesn't want their shares lent, you have to move them to a cash account, because if they're in a margin account, it's not up to you. And this is not our rule. This is firm. This is system wide. So that's an important distinction. And the stock yield enhancement program, to me, is a great benefit, because if you have a margin account and your shares are getting lent, you might as well see some of the benefit, which I think is an important feature.
Yeah, it's aptly named stock yield enhancement. It's a very good program for many, and certainly if one opted to not execute what's called a master securities lending agreement with Interactive Brokers, it's their right not to. But I view it as a very good program.
From an interest rate point of view, unless you have hard to borrow names, you're not missing out on all that much, with rates being 0, 25 basis points. If we start to see a higher rate cycle, as many people predict, and Fed funds rates start to get into numbers that are actually like integers, then that becomes a meaningful help to your performance. So it does behoove you to consider this if you haven't already. I'm going to get to the elephant in the room when people really started to think about short selling, when it came to the fore, and that was the meme stock craze of early 2021. Let me preface it by saying that thanks to you and your colleagues, who I really didn't credit as much as I should have, we got explained something to me that was fascinating. I wrote something that got a good pickup, again, as a result of long conversations with you and your team about how there could be a bigger short interest in GameStop than there was actually a float. And that was a particularly extreme example. And we won't get into that right away, but that was really that whole meme stock craze put short selling into the fore, and to the point where it was, in my thinking, it was the mother of all short squeezes. Could you explain? I could explain the trading mechanics of a short squeeze, and that is basically people realize that there are short sellers who need to cover because they're facing margin calls, or because their stuff is hard to borrow, gets too hard to borrow. There was an old saying, "He who sells what isn't his'n buys it back or goes to prison," which is interesting because it actually came about before there was really Reg Show. That came about 100 years ago or so. But if you could explain some of the mechanics of what you see when we get into these short squeezes. It doesn't have to be a meme stock. They happen with distressing regularity. There's always something that's getting squeezed.
So that was, as interesting a time as any of us can recollect. And by the way, it sure seems like there's some ratcheting up on those same stocks in the last several days. So, we'll see what happens going forward. So to touch on one of the things that you mentioned, how could it be that there are greater shorts than shares that are out there, namely the float? So let's use a very simple example, and let's say the float is a grand total of 1,000 shares to make the numbers easy, and somebody sells short 500 shares and borrows it. Let's call the original long firm A, if you will. And then the firm that shorted it will be firm B. They short 500 shares. And then they borrow the shares from firm A to deliver to firm C. So at that moment, we have total shares outstanding, or the float, if you will, of 1,000 shares. We have a collective short of 500 shares. Everything seems reasonable and intuitive at that moment. Okay. So let's say firm B says, I like my short exposure here. Let me go ahead and short another 500 shares. And they do so. And now they borrow another 500 shares from counterpart A. They deliver it to, I said counterpart, but I meant firm. They borrow it from firm A. They deliver it to firm C per their short sale obligation. And now we have a collective float of 1,000 shares still. That hasn't changed. And a total short amount of 1,000 shares. So they're equal at that moment. And then on, let's say, day 3, hypothetically, he says, I really, really like my short position here, and I would like to short additional shares. So he shorts another 500 shares, and he turns around and he borrows it from, let's say, firm C, loaned it to somebody else. And so what I'm describing here is kind of a circle where the short is ratcheting up, the total float remains the same. No new shares were introduced to the market, and that's how you have that dynamic that you kind of led with.
Yeah, in the case of firm C, he gets delivered the shares, but he has no way of knowing whether those shares are in fact borrowed shares or owned shares. And so
Indeed.
he can then turn around because they're not flagged, they're not tagged, there's no distinction once he receives them. He can then turn around and lend them himself. And so you could find the stuff getting relent, rehypothecated, if you want to use a bigger word, around the street. And because in that situation, firm C is free to lend the shares that he received as a result of firm B's short sale, which were facilitated by firm A, he can then lend them to firm D, who wants to short the stock. And there you have it. So you could end up in that situation where you have 1,000 or 2,000 shares, 1,500 or 2,000 shares shorted, despite the fact that it only being 1,000 shares. And now taken to a grander scale, you would expect to see the rate increase, or in stock loan terminology, get more negative. And so eventually there is a self-limiting factor to it. I think what happened in the meme stock craze was it got taken to the extreme. It became a war, not just an economic event. The winners in this case were the people who seized upon the short selling. But over time, these situations do tend to abate, and you see the ebb and flow. The short. Eventually, they got the big short, which was Melvin Capital, to cover his short in GameStop.
Yeah.
And some of the air came out of both the stock and the lending cost. Explain some of how you see the mechanics going. When they get to extreme, what sometimes causes them to contract back to something more normal?
I was thinking about this in advance of this discussion. So the interesting thing about this dynamic is when you take something like GameStop, and I think it's fair to speculate that the reason why the short interest had been increasing, was the whole prevailing wisdom or theory that brick and mortar stores were going away, and how is GameStop going to survive that, and what have you. And then, what we saw is what you described, and that generally pointed the price as a result of the buy pressure up significantly. So what I would say is, interestingly enough, when the short demand is greater, in other words, prior to what happened in GameStop, a lot of times the rate is at its apex. And after a short squeeze, when shorts have been either forced or because they're panicked a little bit to come out of their shorts because they fear that exposure. Now what that does in effect is it reduces the borrower demand, and therefore reduces the price to borrow. But there's a process there that doesn't happen instantaneously. So the pressure on the rate, is elevated temporarily, but then after the collective short interest is decreased because of people coming out, then what you see is a very quick 180 back to normal rate territory. So I don't want to say it's as volatile as what we saw with the actual price during those times, but there is a volatility based on that collective borrow demand.
That was extreme in every circumstance.
Yeah.
Yeah, I mean, because during normal trading, over the years, we've countless times about like, what's the rate on this? Is it easing? Is it not easing? Anytime you deal with a product that involves forward pricing, derivatives, specifically, the stock lending rate is an important factor of that. Normally, you would say that, well, right now with interest rates around zero, the forward value is basically whatever the value is less dividends. As you start to get positive interest rates, the forward value will be something greater than the present value. Again, plus or minus dividends, unless the stock is hard to borrow, in which case you look at it and see that the forward value is less than the current value because instead of there being a positive interest rate applied, there's a negative interest rate applied. It can be a very interesting situation, particularly for people who trade derivative products.
Right. And I think, what's common in your world trading versus my world stock loan is that there's an emotional component to the pricing. And so you see people making, trading or stock loan trading decisions based on the extreme volatility of a given stock. And so you can see, wild, pricing again in your world and rates in the stock loan world, that tend to calm down over time. So oftentimes during the chaos, things are not as intuitive as they might otherwise be.
That's an important consideration. Another thing that what I'm going to call within the realm of normal special situations, getting away from like the meme stock craziness, there are plenty of what I would call standard situations when you find that stocks become hard to borrow. Some of them being M&A transactions. If company A is being acquired by company B, and rather than paying cash, the holders of company A receive company B shares, there's a natural trade there, which would be buy A, short B. You see that happen. If there are warrant deals, you start to see the people buy the warrant and sell the stock against it. What are some of the ones that are on your radar these days? A lot of it, I would imagine, is SPAC arbitrage, where there are warrants that are exercisable, or after a de-SPACing, for lack of a better word, there are warrants out there.
SPACing was probably elevated the most during 2021, I suppose to a degree in 2020, but far more in 21. It has largely calmed down in recent months, but I think the general big picture thing that you're describing is whatever the corporate action event, be it M&A or any other. We saw a recent ADR that was taken off the books. That's the catalyst. That's the front end thing that we deal with 2 days later, come settlement date of whatever that catalyst was, right, is going to sort of dictate the supply and demand within the stock loan market. We're certainly aware of things that happen on the front end, and that's not limited to corporate actions. That includes what we call pre-market movers, or just fast moving stocks due to some news, or maybe not a lot of news, and we we just see wild and wacky activity in terms of the price of a given stock. It certainly hits our radar to say, come a couple of days later here, when this thing impacts the stock loan market, it's something that we want to be very aware of.
So it's important for listeners to realize that the stock loan traders are just as sensitive to news, fast moving stocks, corporate actions, as are any other traders on the street. And in many ways, their business is more dictated by that, because many of the market coming and goings that create news or movement don't get reflected in stock loan, but the ones that do get reflected in stock loan really get reflected in stock loan.
Yeah. And I think that the speed and efficiency of being proactive in advance of that first settlement date when things start to happen, as opposed to reactive is really one of the facets that makes a good stock loan trader is the ability to be ahead of the curve and not totally reactive to it.
What else makes a good stock loan trader? What else goes into success in the stock loan side of the business?
It's an interesting role because have good relationships within the firm, be it the clearing department, the corporate actions department, the treasury department. You have to be able to maintain good relationships with street counterparts because after all, that's who you're transacting with on a daily basis. You have to be able to consume news as efficiently as possible to shape your decisions. It's interesting. There's an analytical aspect to it, but there's also a salesy type aspect to it that's unique to a lot of back office jobs or roles. And traditionally, stock loan has been a back office, or at least defined as a back office role.
I would call it
So
more middle office as much as anything
yeah,
else.
that's fair. That's fair. But yeah, I think all of those things. So it takes a diverse skill set, if you will, to succeed. And at Interactive Brokers, we have an outstanding group that I'm very proud of. So I think we're approaching our jobs in each day in the right way.
That's awesome, and I think that's actually a great place because you and I have been talking for a long time. I think that's probably a good place to sort of finalize where we are. I just have a couple of notes here that we talked about the rule changes that are coming. It's actually Exchange Act Rule 10C1, which I have thanks to your notes to me.
Yep.
So people who want to look at that, that would be that would be something to look at on the SEC's websites. And one other thing which we didn't touch on was the upcoming change to T+1, which is being talked about as opposed to T+2. That was another thing people were screaming about in the meme stock era. I am a firm believer that every day you shorten the settlement cycle, you remove a small not insignificant. You remove a large element of risk from the system because there's just that much. There's one day less that something bad can go on between trade and settlement. How will that
Yes.
affect you?
Well, I think you hit on the most important component, which is cutting in half, literally, the systematic risk at the clearinghouses and that price volatility that can occur between trade and settlement date. So that is critical. In terms of stock loan, it's really going to move all the time periods. In other words, the time period that, like if you send a recall, which is asking for a stock loan back, if it were to come to a buy-in situation, currently it's 2 days from the day that you recall it. That would be reduced to 1 day. It would reduce all of the reg show time periods. All of that would just kind of fall in lockstep with the change going from 2 to 1, as it did, by the way, with the change from 3 to 2 a couple of years ago. We are still 2 years away from moving to T+1. So there's nothing right around the corner per se, but we look forward to it when it is implemented.
Does it add efficiency to your side of the business? Or does it just speed things up by a day? Obviously, systemic risk aside, which I think we're in complete agreement that that's a good thing. Does it?
I know that Interactive Brokers will handle it well. We're extremely automated. So I think we will react well to it. I do have a little bit of concerns about, some firms' ability to turn around the prior day's trading into stock loan recommendations the following day. That seems like it's a challenge that perhaps some other firms might struggle with. I don't want to speak for them, but in the back of my mind, I do wonder about that. For us, frankly, it's mostly a flip of a switch and we're ready overnight. But I do wonder about the street's collective ability to handle the change. Now, the fact that they're getting, that everybody's getting 2 years lead time to build up to that, maybe that challenge is not something to be concerned about.
I guess we'll find out in 2 years.
Indeed.
We're gonna wrap it up here. I've been talking to my friend and colleague Bill Pepe. manager of Interactive Brokers Stock Loan for North America. You've been listening to Interactive Brokers Traders Insight Radio. You could find our stuff regularly published on tradersinsight.news. One of the most popular features typically is the most interesting stock loan names that Bill and his team puts on there. I strongly urge you to keep an eye on that when they come out. And I strongly urge you to stay in touch with us via Traders Insight. And I want to thank you once again, Bill, for taking the time to join me.
Yeah, my pleasure. I appreciate the opportunity.
All right. I think we'll leave it there. Thank you.
Thanks for listening to Traders Insight Radio. As always, there's more content at tradersinsight.news. And if you're interested in learning more about Interactive Brokers, visit IBKR.com. We offer more trading education materials such as webinars at ibkrwebinars.com, market-related courses at tradersacademy.online, and quant-related articles at ibkrquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice. Trading on margin is only for sophisticated investors with high risk tolerance. You may lose more than your initial investment. For additional information regarding margin loan rates, see ibkr.com/interest.